Marcus Johnson stared at his bank account balance on a cold January morning in Chicago. The number glaring back at him was $2,847.32. The same stagnant amount that had barely moved in 3 years. Despite working 60-hour weeks at his marketing job, at 32 years old, he realized something terrifying. He was running in place while the world around him was sprinting forward. This is not just Marcus's story. This is the story of millions of Americans who wake up one day and realize that working hard is not enough. In the modern era, your money needs to work as hard as you do, perhaps even harder. It was a casual conversation with his college roommate, David Chun, that planted the first seed. David had started investing 10 years ago with just $500 in a technology ETF. Secret isn't a secret at all, David explained over coffee. It's time, consistency, and understanding where the world is heading. And right now, the world is heading toward technology and financial innovation. Marcus went home that night and couldn't sleep. He spent hours researching, reading, and watching videos about investing. What he discovered was both frightening and exhilarating. The frightening part: he'd already lost 10 years of potential compound growth. The exhilarating part: it was never too late to start, and the tools available today made investing more accessible than ever before in human history. The first thing Marcus learned was that the investment world of 2024 was radically different from his parents' generation. His father had worked for the same company for 35 years, received a pension, and retired comfortably. That model was essentially extinct. Today's reality demanded personal responsibility for retirement. The 401k had replaced pensions. Social Security was uncertain, and inflation was silently eating away at savings accounts that paid a mere 0.5% interest, while the cost of living increased by 3 to 7% annually. But here was the opportunity. Technology had democratized investing. What once required thousands of dollars in minimum investments and expensive financial advisors was now available through smartphone apps with no minimum balance requirements. Commission-free trading had become the norm. Information that was once locked behind expensive subscriptions was now freely available. The playing field, for the first time in history, was leveling. Marcus's research led him to a crucial insight. Every major economic shift in human history created wealth for those who positioned themselves correctly. The agricultural revolution, the industrial revolution, the information age. Each transition created new millionaires and billionaires. We are now living through two simultaneous revolutions: the artificial intelligence revolution and the financial technology revolution. These sectors are not just growing, they are fundamentally reshaping how humanity lives, works, and transacts. Consider these facts that Marcus discovered. The global technology sector grew from $5 trillion in 2019 to over $8 trillion by 2024. Companies like Apple, Microsoft, NVIDIA, and Google, parent Alphabet, weren't just successful. They were becoming the infrastructure of modern civilization. Every business, every government, every individual was becoming increasingly dependent on their products and services. The financial technology sector was equally explosive. Traditional banking was being disrupted by digital payments, cryptocurrency, blockchain technology, and innovative lending platforms. Companies that could successfully merge finance and technology were experiencing unprecedented growth, but perhaps most importantly, these two sectors were increasingly merging. Financial services were becoming technology companies. Technology companies were becoming financial services providers. The lines were blurring, creating opportunities for investors who understood this convergence. Marcus decided to take action, but he committed to doing it intelligently. He opened accounts on 3 platforms: a traditional brokerage account with Fidelity, a Roth IRA for tax-advantaged retirement savings, and a high-yield savings account for his emergency fund. His first rule was simple: never invest money you might need within the next 5 years. The stock market could be volatile in the short term. He needed to build a safety net first. He calculated his monthly expenses and set aside 6 months' worth in his high-yield savings account, which paid 4.5% APY. Not enough to build wealth, but enough to protect against emergencies without losing to inflation. His second rule was to automate everything. He set up automatic transfers to occur the day after each paycheck. $500 went to his Roth IRA. $300 went to his taxable brokerage account. The money was invested before he ever saw it, removing the temptation to spend it. His third rule was to start with what he understood. Rather than trying to pick individual stocks immediately, Marcus began with diversified exchange-traded funds, or he allocated 50% to a total stock market ETF that gave him exposure to the entire U.S. economy. He put 30% into a technology-focused ETF that concentrated on the sector he believed would drive future growth. The remaining 20% went into a financial sector ETF that captured banks, insurance companies, and emerging fintech players. The hardest lesson Marcus had to learn was not about numbers or strategies. It was about psychology. The stock market tested emotional discipline in ways that nothing else could. During his first month of investing, the market dropped 7%. His $800 in investments became $744. Every instinct screamed at him to sell, to cut his losses, to protect what remained. This was where most new investors failed. They bought high on optimism and sold low on fear, locking in losses permanently. Marcus forced himself to do the opposite. He remembered what David had told him. Market drops are sales. You don't panic when your favorite store offers a discount. You buy more. He didn't just hold through the downturn. He added an extra $200 that month, buying shares at lower prices. When the market recovered 2 months later, that $200 had become $260. This single experience taught him more about investing than any book or video could. Long-term success wasn't about finding the perfect stock or timing the market perfectly. It was about consistency, emotional discipline, and the patience to let compound interest work its magic. 6 months into his journey, Marcus's portfolio had grown to $7,400. It wasn't life-changing money yet, but the habits were forming. The knowledge was accumulating. The foundation was being built. He began studying individual companies more carefully. He wanted to understand not just what these businesses did, but why they would continue to dominate in the decades ahead. He started reading annual reports, listening to earnings calls, and following industry trends. The technology sector fascinated him most. He learned about cloud computing, artificial intelligence, semiconductor manufacturing, and cybersecurity. He discovered that behind every trend was a supply chain of companies benefiting from growth. Marcus was no longer just saving money. He was becoming a student of business, economics, and human behavior, and that education was about to take him to the next level. In the coming months, Marcus would dive deeper into selecting individual stocks in the technology and financial sectors. He would learn the specific metrics used to evaluate companies and discover how to balance risk with reward as his portfolio grew. The role of emerging technologies like artificial intelligence would become central to his strategy, and he would identify the companies positioned to benefit most from this revolution. But all of that required patience, and patience, Marcus was learning, was the investor's greatest weapon. 1 year into his investment journey, Marcus sat in his small apartment surrounded by notebooks filled with research. His portfolio had grown to $14,200, but more importantly, his understanding had grown exponentially. He was ready to take the next step, investing in individual stocks. The transition from ETFs to individual stocks was like moving from swimming in the shallow end to diving into the deep ocean. The potential rewards were greater, but so were the risks. Marcus understood that picking the wrong company could mean losing everything he invested in it, but picking the right company could mean returns that far exceeded any index fund. He developed a systematic approach. Every weekend, he dedicated 4 hours to research. He read company filings, analyzed financial statements, and studied industry trends. He created a watch list of 30 companies and narrowed it down based on specific criteria he had developed through months of learning. The first criterion was revenue growth. Marcus looked for companies that had grown their revenue by at least 15% annually over the past 5 years. In the technology sector, this was often achievable. In the financial sector, he looked for companies that were disrupting traditional banking models and capturing market share from established players. The second criterion was profitability, or a clear path to profitability. Many technology companies operated at a loss in their early years as they invested heavily in growth. Marcus learned to distinguish between companies burning cash with no clear plan and companies investing strategically to capture massive future markets. He looked at gross margins, operating margins, and free cash flow trends. The third criterion was competitive advantage. This was the concept Warren Buffett called a moat, something that protected a company from competitors. In technology, this could be network effects, proprietary technology, high switching costs, or economies of scale. Marcus asked himself a simple question about every company. If a well-funded competitor tried to replicate this business, how long would it take and how much would it cost? The fourth criterion was management quality. Marcus spent hours watching interviews with CEOs and reading their shareholder letters. He wanted leaders who thought long-term, communicated honestly about challenges, and had significant personal investment in their companies. When executives owned substantial stock, their interests aligned with shareholders. His first individual stock purchase was NVIDIA. The company had transformed from a gaming graphics card manufacturer into the backbone of the artificial intelligence revolution. Every major AI system required NVIDIA's chips for training. The company's data center revenue had exploded, and Marcus believed this was only the beginning. He remembered the evening he finally clicked the buy button. His hands were slightly shaky as he purchased $1,000 worth of NVIDIA shares. It felt different from buying an ETF. This was a bet on a single company, a single vision, a single future. His second purchase was Microsoft. The company had successfully reinvented itself under CEO Satya Nadella, transforming from a stagnant software giant into a cloud computing powerhouse. Azure was growing rapidly, and Microsoft's integration of AI across its product suite positioned it perfectly for the coming decade. Marcus appreciated that Microsoft generated enormous free cash flow, paid a dividend, and had a fortress balance sheet. For his financial sector allocation, Marcus chose a combination of traditional strength and disruptive innovation. He invested in J.P. Morgan Chase, recognizing that the largest U.S. bank had the resources and talent to compete with fintech upstarts while maintaining its dominant position. Jamie Dimon's annual letters had convinced Marcus that this was a well-managed institution prepared for any economic environment. But he also wanted exposure to pure financial technology. He invested in Block, the company formerly known as Square. Its Cash App had become a financial hub for millions of Americans, and its acquisition of Afterpay positioned it in the buy now pay later space. The company was building an ecosystem that could eventually rival traditional banks. Marcus made a critical decision early in his stock-picking journey: position sizing. He never allowed any single stock to exceed 10% of his total portfolio. If a stock grew beyond that threshold, he would trim his position and reallocate to other opportunities. This discipline protected him from catastrophic losses if any single bet went wrong. He also maintained his core ETF holdings. Even as he added individual stocks, 50% of his portfolio remained in diversified funds. This balance gave him the potential for outperformance through stock picking, while maintaining a foundation of broad market exposure. The education continued. Marcus learned about the semiconductor supply chain and discovered that NVIDIA was not the only company benefiting from AI. Taiwan Semiconductor Manufacturing Company produced the actual chips that NVIDIA designed. ASML Holding made the machines that allowed Taiwan Semiconductor to manufacture at cutting-edge scales. Applied Materials provided equipment and services to chip manufacturers worldwide. This understanding of supply chains became a powerful tool. When Marcus believed in a trend, he could identify multiple ways to profit from it. He didn't need to pick the single winner. He could invest in the entire ecosystem. The artificial intelligence revolution particularly fascinated him. He spent weeks understanding the technology: machine learning, neural networks, large language models, and their applications. He realized that AI was not a single product or company, but a general-purpose technology that would transform every industry. Healthcare companies would use AI to discover drugs faster and diagnose diseases earlier. Financial institutions would use AI to detect fraud and automate trading. Retailers would use AI to optimize supply chains and personalize customer experiences. The companies that best integrated AI into their operations would gain significant competitive advantages. This insight led Marcus to look beyond pure technology companies. He started evaluating traditional businesses through the lens of AI adoption. Which retailers were investing in AI? Which banks were building internal AI capabilities? Which healthcare companies were partnering with AI startups? He discovered that the biggest winners might not be the AI companies themselves, but the companies that most effectively used AI to enhance their existing businesses. A retailer that reduced inventory waste by 20% through AI-powered demand forecasting would see immediate profit improvements. A bank that automated customer service through AI chatbots would reduce costs while improving customer satisfaction. 18 months into his journey, Marcus's portfolio had grown to $28,000. His individual stock picks had outperformed his ETF holdings, validating his research approach. But he remained humble. He knew that a rising market lifted all boats, and true skill could only be measured over full market cycles. He experienced his first significant test when one of his holdings, a smaller fintech company, dropped 40% after missing earnings expectations. The loss stung, but because of his position sizing discipline, the impact on his total portfolio was limited to 4%. He analyzed what went wrong, determined whether the thesis had changed, and ultimately decided to sell and reallocate to higher conviction positions. This experience reinforced an important lesson. Being wrong was inevitable. The goal was not to be right every time, but to be right more often than wrong and to limit losses when wrong while letting winners run. Marcus also learned about the importance of tax efficiency. He held his highest growth stocks in his Roth IRA, where gains would never be taxed. He kept dividend-paying stocks in his taxable account, where qualified dividends receive preferential tax treatment. He harvested losses strategically to offset gains in profitable years. The knowledge compounded just like his money. Each lesson built upon previous lessons. Each mistake taught him something valuable. Each success reinforced good habits. As he approached his second anniversary of investing, Marcus began thinking about the next phase, building multiple income streams, protecting his growing wealth, and planning for the long-term future. The foundation was solid, the habits were ingrained, the knowledge was substantial, but the journey was far from over. In fact, the most important lessons were still ahead. 3 years had passed since that cold January morning when Marcus stared at his bank account in despair. The man who once had $2,847 to his name now sat at his kitchen table, reviewing a portfolio worth $127,000. But the transformation went far beyond the numbers. Marcus had become a different person entirely. The journey had not been smooth. During his third year of investing, the market experienced a significant correction. Technology stocks fell 25% in 2 months. But Marcus had prepared for this moment. He had read about every major market crash in history. A Canoe.c 2008 financial crisis had seen the market drop over 50%. A Canoe that the 2020 pandemic crash had been swift and terrifying. He also knew that investors who held through those periods and continued buying had been rewarded handsomely. He called David during the worst of the downturn. His voice was steady, but his emotions were turbulent. David listened patiently and then said something Marcus would never forget. "Marcus, you are not losing money. You still own the same number of shares. Those shares represent ownership in real businesses that are still generating revenue, still innovating, still serving customers. The price the market assigns to those shares today does not change the fundamental value of those businesses. If anything, this is an opportunity to buy more ownership at a discount." Marcus not only held his positions, but increased his monthly contributions. He moved money from his emergency fund, which had grown beyond 6 months of expenses, and deployed it into his highest conviction positions. When the market recovered 8 months later, those purchases made during the downturn had gained over 40%. This experience fundamentally changed his relationship with market volatility. He no longer feared downturns. He welcomed them as opportunities to accelerate his wealth building. The emotional discipline that had once required tremendous effort became natural. As his portfolio grew, Marcus recognized the need for diversification beyond stocks. He began researching real estate investment trusts, which allowed him to own commercial real estate without the hassles of being a landlord. He allocated 10% of his portfolio to REITs focused on data centers and cell towers, recognizing that these properties would benefit from the same technology trends. Driving his stock investments, he also explored dividend growth investing. He identified companies that had increased their dividends every year for decades, regardless of economic conditions. These dividend aristocrats provided a growing income stream that would eventually supplement and perhaps replace his employment income. The concept of financial independence began to take shape in his mind. He calculated his annual expenses and determined that he needed approximately $50,000 per year to maintain his lifestyle. Using the 4% safe withdrawal rate that researchers had established, he would need $1.25 million to achieve financial independence. At his current savings rate and expected returns, he would reach that goal in 12 years. But Marcus was not content to wait. He looked for ways to accelerate the timeline. He started a side business sharing his investment knowledge. What began as a simple blog evolved into a YouTube channel and eventually a paid newsletter. The income from this venture was modest at first, perhaps $500 per month. But every dollar of that income went directly into investments. More importantly, teaching forced him to clarify his thinking and deepen his understanding. The financial sector continued to evolve, and Marcus evolved with it. He witnessed the rise and fall of cryptocurrency speculation, choosing to maintain a small position in Bitcoin and Ethereum as a hedge against traditional financial system risks. He watched fintech companies mature from disruptive startups into established players. He saw traditional banks adapt and incorporate technology, blurring the lines between old finance and new. His technology thesis proved remarkably accurate. Artificial intelligence moved from experimental curiosity to essential business tool. Companies across every sector raced to integrate AI into their operations. The semiconductor companies he had invested in saw their revenues multiply. Cloud computing providers reported accelerating growth as businesses moved their AI workloads to the cloud. But Marcus also witnessed failures. Several high-flying technology companies collapsed as interest rates rose and unprofitable business models became unsustainable. Companies that had been valued at billions became worthless. This reinforced his focus on fundamentals: revenue growth, profitability, competitive advantage, and management quality. 5 years from his starting point, Marcus's portfolio crossed $250,000. The compound growth was becoming visible. His money was generating returns that exceeded his monthly contributions. The snowball was rolling downhill, gathering mass and momentum. He made adjustments as his wealth grew. He increased his emergency fund to 12 months of expenses. He purchased umbrella insurance to protect his growing assets. He established a trust and created a basic estate plan. Wealth preservation became as important as wealth creation. Marcus also learned the importance of giving. He set aside 5% of his investment gains each year for charitable contributions. He mentored young people from his neighborhood who reminded him of his former self, young people who had never been taught about investing, compound interest, or financial independence. The lessons he shared were simple but profound. Start early, because time is your greatest asset. Invest consistently, regardless of market conditions. Focus on businesses, not stock prices. Maintain emotional discipline during volatility. Diversify to protect against unknown risks. Continue learning, because financial markets constantly evolve. 7 years from that January morning, Marcus walked into his office and submitted his resignation. He did not stop working. He loved building his educational business too much to abandon it. But he now worked because he chose to, not because he had to. The psychological shift was profound. He negotiated from strength rather than desperation. He took on only projects that excited him. He spent more time with family and friends. Marcus often reflected on the decisions that had transformed his life. The choice to start investing despite knowing nothing. The discipline to continue during market downturns. The patience to let compound growth work over years rather than seeking quick profits. The humility to admit mistakes and learn from them. The courage to bet on technologies that would shape the future. He thought about what would have happened if he had never started. If he'd continued working 60-hour weeks while his savings stagnated. If he'd let fear prevent him from taking action. The alternative path was too painful to contemplate. The financial system in America offered remarkable opportunities for those willing to learn and participate. The stock market had returned approximately 10% annually over the past century, turning patient investors into millionaires. The technology revolution was creating new industries and new wealth at unprecedented rates. The tools for participating had never been more accessible or affordable. But these opportunities required action. Knowledge without action was worthless. Fear without courage was dreams without discipline remained dreams. Marcus understood that his story was not unique. Thousands of ordinary Americans were walking similar paths, building wealth through consistent investing in quality businesses. They were teachers and engineers, nurses and salespeople, young people just starting their careers, and middle-aged workers who had started late. They shared a common belief that their financial futures were within their control. The modern era demanded new approaches to building wealth. Pensions were gone. Social security was uncertain. Inflation eroded the value of idle cash. But for those who understood the game and played it intelligently, the rewards were extraordinary. Marcus looked at his portfolio one final time. The number was impressive, but it was not the number that mattered most. What mattered was the freedom it represented, the security it provided, the options it created, the legacy it would leave. He closed his laptop and walked outside into the morning sun. The same sun that had witnessed his despair 7 years ago now witnessed his freedom. The journey had been long, sometimes difficult, often uncertain. But every step had been worth taking. And somewhere in America, another person was staring at their bank account in despair, not yet knowing that their journey was about to begin. T. N.